What's up, everybody? Michael and Coco here. You're watching the Daily Stock Market Brief, the video that I do Monday through Friday. That's 5 days a week. We use technical analysis to get a good sense as to where the market might be headed next. And lately, it has just been going up because that's what stocks do, right? In today's video, thumbnail said the biggest short. You're probably wondering, what the heck am I going to be talking about? Well, we got a lot of charts to go over, got a lot of indicators to go over. We're going to be mapping out the dollar as well. We're bringing in some commodities. Got a whole lot to talk about, and then I'm going to wrap it up in the conclusion section. Oh, and I'm going to start off with a little bit of a story. Let's get into it. All right, welcome back. Yes, that is a picture of Best Buy. Why? Well, in 2004, I used to work at Best Buy, and I remember one particular customer. When I was 17 years old, he was probably around the age of 30, 35, probably my age right now. And what I found so interesting is he came in because he worked for a brokerage firm where he was starting a brokerage. And in order to do so, he had to buy a lot of different things. So top of the line computers, top of the line, just desks, utilities, chairs, everything and anything possible. Price was not an option for this guy. He had to show me his Lamborghini that was parked outside. Now, when I come to think about it, more grown up, back then when I was 17, I was like, I want to be able to do something like that. But when you think about it now, what I find so interesting is that was during the most euphoric time where many, many people were able to make a lot of wealth in the real estate industry. There was people flipping houses. There was people, investing in home builders. There was people, selling real estate, refining, you name it. There was a lot of people becoming very wealthy very quick. And this is why I posted earlier on Twitter today in regards to how building wealth should really look and what really happens to people that get wealth in a very compressed amount of time that aren't used to those shifts. Well, typically they end up doing dumb things. But what I want to just point out here is understanding the dynamic of euphoria. When people out of nowhere become very, very wealthy, they think that nothing can go wrong, so they put maximum exposure into one direction, not realizing what the risk is around the corner. So in the case of the guy that was at Best Buy that I randomly met, well, who knows what happened to him during the crash, but what I can assume is being a person that has to show your wealth and be very flamboyant and this and that to a 17-year-old boy that works at a Best Buy retail store, chances are he wasn't prepared for a market to completely turn and flip. Thus, probably he was max exposed and got maximum pain. I'm telling you this story because if you're feeling, one, very euphoric because you've been making up a lot of money, be very careful. And two, I'm also bringing it up just because of the fact if you haven't been in the markets and you are missing out on all of this awesomeness, don't feel that fear to get in at the last moment. So the S&P 500, this is very interesting, right? We broke above the broadening wedge and the megaphone pattern, another record, and we closed pretty much the week on the all-time high, pressing right around 3,700. So just a monster move. Now, a lot of people will be like, well, you've been a bear for all this long. Well, keep in mind, not too long ago, I did post this video called The Big Trap, and it literally looks just like that, how it's drawn out. It's kind of funny. And I still believe that we will be able to push up higher because of the context, but we are still very overextended. Now, on the daily time frame, we're up at the upper portion of the Bollinger Band, just like the weekly, continue to push higher, and then we're up on this little channel trend line up at the very top too. Most of this move has been progressed by monster gaps to the upside. Okay, let's look at the Dow Jones. I'm going to go into a little bit more detail on the Dow Jones. And like I said, during the conclusion section, I'm going to kind of wrap everything together. So here it is on the daily time frame. I pointed out this bull pennant-ish. The way that I drew it out is more of an ascending triangle. And then we saw the breakout and hold above. So we saw the context move up. In yesterday's market brief video, we talked about the possibility of that taking place. Now, what I want to point out, what I thought was really cool, and I also posted this on Twitter, was this is 2020. So we had the big crash, and then we've been kind of, ping-ponging around this channel. And then we're starting to move up higher, okay? What I want you to pay attention to is the pink lines, that's the price action, and then the blue lines, which is the price. Look, notice how we're at 30,000 here, and then we were down here at around 26.5, okay? And then goes up, down, up, down, up. And I just find this pretty crazy to me. So and this is a 1987 stock market crash, and this is on the weekly time frame as well. It took one a lot longer to get up, and we'll talk about that in the conclusion why why we moved up so quick. But notice the price action here when it came back to its all-time high. We came up, we came down. So up, down, and then we blew off to the all-time high and really reached up higher onto the upper Bollinger Band. If you look to the right, look at the price, 3,000, which was just funny to me just because, we did the same thing right here at 30,000. And then not to mention the very down portions of this right here is right around 2,500, 2,600. So, and then right here, it's the same thing, 25,000 is a little bit lower, but 26.5 right there. So I just found that the price action, how it responds when it reached back up to an all-time previous high was quite interesting. And then once it did have that big move to the upside, we did see it draft down to the downside. Another thing that's very similar from now to 2087, oh my God, I'm losing my mind, 1987, is this right here is the Dow Jones Composite. And then the Dow Jones Composite is made up of transports, utilities, and then we have the industrials as well. So these three composites right here. And similarly, I don't have the 1987 chart up, but what we did see is a very same divergence. We saw the Dow Jones Composite moving up higher and higher, the transports moving up higher, and the industrial average moving up higher, all while the utilities kept on sinking. So this is very, very similar playbook to as what we saw in 1987. Now, or the late 80s to the early 90s. Now, what's important about this to understand is if you see these diverge for weeks at a time, you need to take note because of the fact they are supposed to move in unison with each other. You can see throughout history, like on the daily time frame, it's okay, for 4 or 5 trading days, 7 trading days, whatever. Once it starts getting up to multiple weeks and months of a divergence, you need to understand that that divergence can potentially cause quite a bit of problems in the very near future. So we have the utilities being more of a risk-off trade, but that still doesn't mean that it shouldn't be, at least moving up a little bit higher or at least reaching all-time highs like the other indexes here, at least very shortly. So what can potentially happen in these cases is when we see a move higher in utilities, it might show us more of a risk-off type move and send these averages down. But you need to understand the more they diverge, the more potential of a rip to the downside or the more exposed we are for the other averages to potentially move down as well. So look at the Russell 2000. Russell 2000 on the monthly time frame. Right, big bullish candle here, and then we continue to move higher, pretty much at the high. We're up 3.97% so far, completely extended from the upper Bollinger Band, okay? Yeah, it's in bullish context. Yeah, this big move, but keep in mind, it is very, very overextended. So the people that are going to be going long here, notice you're going long at a top and at an overextension. So that's why I've been saying you got to be very, very diligent with stop losses. On the weekly time frame, we have this channel. This up channel, so it's bullish context, disconnected from the 5 EMA, and the price action is also above the upper Bollinger Band. This does not happen frequently. This is not normal market behavior. Now, yesterday we talked about this kind of cupping pattern on both the 15-minute and the daily, and we said if it breaks above 185, it could squeeze higher. What do you know? It pushed a lot higher through that level today. And we also mentioned that I thought that it was going to make a new high on a negative divergence. And what do you know? That right there is a negative divergence with a new all-time high. NASDAQ 100, let's go into that. NASDAQ 100, negative divergence on the monthly time frame, upper range of the Bollinger Band, completely disconnected from the 5 EMA. This is very, very overextended. That does not mean that the market can't continue to go higher. Okay? That's not what it means, but it means you got to be very, very careful with your long positions. On the weekly time frame, we broke out of the symmetrical triangle, we back tested the 5 EMA, and we're continuing to move up higher. Mind you, we are at the upper range also on that Bollinger Band. And then we have the semiconductors. This was the rising wedge pattern. We broke above that, so that could very well squeeze us higher. This does not bug me by any means that this went higher. Keep in mind that is very, very frothy RSI, which doesn't mean that it's going to come down completely. Although when it does get up to these levels, sometimes we do see that take place. We need to wait for it to cross back down to basically be a little bit more concerned. But also keep in mind this this overbought territory is happening above the upper Bollinger Band, also on the daily time frame. So very, very distorted stuff. Now, before I get into the indicators, I want to also just point out the fact that when bubbles blow up, not blow up, when they, actually, you know what? I'm just going to talk about that in the conclusion. Let's get into the indicators. We're going to talk about the VIX first. The VIX, we said that on Fridays, what typically happens? Well, the VIX typically goes down on Fridays, which gives us more thrust to the upside in the indexes. So we're still within this falling wedge type pattern, which is bullish, still around this gap that can act as a level of support. And you never know, if we break out, it could very well shoot us to 27.5 right there. Now, another thing is the CPC. This is a sentiment indicator. It's smooth over 10-period moving average. Double bottom taking place right here. The CPC is just completely just full bull right here, okay? This is the 10-period moving average. If we start seeing this move up, it could be a very potential similar type situation that we saw in September. So we're going to have to monitor this closely. When it crosses back above the red line, that is actually the sell signal. So when it gets up there, that's when we actually got to be more protectant. But just know that it's a lagging indicator. So when it crosses above that, it could go just maybe down a little bit or sideways like it has previous times. But sometimes when we have this kind of price action on the smooth period moving average, this might be an indicator that, okay, very soon that we might start seeing it move up. Now, what I find very interesting is on the CPCE, which is the equity side, not the total, the last time that it hit these low levels, so 0.35, was in 2010. It was April 2010, probably the 14th. Now, keep in mind, this is the S&P 500. What happened shortly thereafter, after reaching those euphoric levels of bullish sentiment? Well, boom, to the downside. Now, on the monthly time frame for the CPCE, you can see here, it's never been this low on the monthly time frame for a close ever. So if we close down at these levels for December, that will be a historic low on the monthly time frame. This right here is the sentiment surveys. So we're looking at more sentiment. Obviously, sentiment is extremely bullish. I talked about this yesterday, so I won't get too into depth. But what we see here is a negative divergence, both on the surveys for the bulls and the ratio itself. And it's an overextended territory as the market continues to push higher. Last time this took place was in 2018, and that's when we saw that pretty big rip to the downside. Okay, here is the NIM exposure index. This tells us what asset managers are basically doing. Are they really bullish? And it really shows that they are full bull right now. And then you have the RIDEX asset. This is real money. What are they doing? Well, the high, or the basically higher, technically lower, the way that I have this chart set up. The lower this goes, I mean, it hasn't been this low for quite some time. As you can see, this right here is just saying the market, the higher these move, right, the higher they push up, this market is just extreme bull mode right now. And then we have the NI high low. This right here is pushing 97.98. Very, 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 very high number. And this goes the same with the NASDAQ high-low index too. A very, very, very high number. You can see when it reaches these high levels, sometimes you get some pretty aggressive pullbacks. The breadth indicator, breadth, we saw a little bit of a shoot up today in breadth, 53.97. But, you know, it came so, you know, on an all-time market high, and it didn't really reach, you know, like we didn't see a burst of, you know, energy come really in. So that's kind of interesting, a little bit of a negative divergence taking place. We really need to see if we want to continue to have the market press these kind of levels. What we really need to see happen is even more of a burst of breath take place. Now, here's the NASDAQ 100. This is an indicator that shows us the percent of stocks above the 200-day moving average. And sometimes when it gets to these overextended ranges, it can hold, but also it can snap back pretty quick. So we're at 89%. 89% of stocks in the NASDAQ 100 are above the 200-period moving average. That is a very, very frothy number, and you can see that the market's on an all-time high right here and pushing somewhat, some could say potentially a double top. Is there more move or more momentum in this move? It's very possible. Just note that we're in overextended territory. Here's the same type of indicator, but for the S&P 500, 91.78% of stocks are above the 200-period moving average. So a lot of stocks on a big thrust move as the index continues to push higher and higher. And then you have the 50 period down here, 82% of the stocks above it. When they both have overextended moves into these indicators right here, typically where the blue lines are, you can see pullbacks take place. So we need to be careful in these environments. And then we have two indicators. The next two is the BPNDX and the BPSPX. This is showing us the percent of stocks on buy signals based on point and figure charts. these still indicate that there could be potentially more room to go in the market. So we got to, you know, be patient for that. But you can see right here, the RSI is not nearly overbought yet, 61.77. We're seeing a big move up. 74% of stocks are in technically buy signals. And then for the S&P 500, 76% of stocks are on buy signals. Market moves to an all-time high and still not overbought there as well. I'm talking quick today, but I want to get through this, okay? Commodities, gold. This is very interesting. We broke out of the rising wedge, but we're still below this trend line and still below the 50 period. I don't know if we can hold too much weight on this move yet. It does look nice that we bounced from the 200 period moving average, but that could be a temporary thing. So we got to be very careful. And why is this so important? And why am I saying this? Well, honestly, the dollar broke, and I'll go into the dollar here shortly, but it broke down pretty significantly from its level, and gold really didn't move at all, which is very surprising to me. And it somewhat of a warning sign. And then we have silver bounce from this level, solid move to the upside, some upper wicks right here. It's kind of consolidating with a little bit higher highs, but you know, we're on a good note. We're right above the 50 period moving average. I believe 24.19 in the close today. Yeah, by a few cents. So you can call it technically we're above the 50 period moving average, but we got to hold that there. The MACD did cross back over, so that's good. And then we have this trend line that we still need to get and break above, all right? And we'll get into the dollar right now. First off, I want to say that we drew out these falling wedges on the dollar, and we did it on gold as well. And we're like, well, one of these is going to break to the upside. Well, it was gold, and then the dollar broke down through 92, which we kind of said, hey, when it gets through 92, we can see it head lower. And that's a pretty aggressive drop to the downside. Note the RSI moving into oversold territory. And what I really want to point out now is the weekly time frame. The weekly time frame is quite shocking, to say the least. First off, I want to point out here from 2017 to April of 2018, we were in this weekly, well, it's a weekly time frame, so quite a while for this falling wedge type pattern to occur. And it did so at the very bottom on a positive divergence in the RSI. Okay, and then we broke out, reached right back up to its previous high up here at around 103. Okay, you can see that move. And then when we got to these levels in 2020, take a look at what's taking place. So this year, we're doing this very similar type pattern, okay? Falling wedge pattern, reaching very low levels, and it's doing so right now on a positive divergence, all right? Now, what's so interesting to me about the dollar is while the dollar has been sinking pretty hard, the equity market has been just rocketing and ramping. So I feel like this dollar, although we're losing, you know, purchasing power in the dollar, you're seeing the equity market really start to scream higher. Now what can concern me is if we see a very similar type breakout of this falling wedge. Like I said, MACD is positive divergence and the RSI currently is at a positive divergence. Okay, if we see this breakout, that's going to put just one heap of ton of pressure on the equities market. So we need to be very just careful in this particular environment. What's the green shaded box? Well, the green shaded box is just a zone of support. So we have from 89 to 91. It can go lower, okay? That's totally fine, but the reason why I put it here is because the high portion of it, we saw it pull down and then hit up, and then we came back down into this range, okay? And then you could see a little bit of a consolidation right here, and then we really ramped up through that level. All right, so yeah, we ramped up, consolidated, and then burst through. So I have a strong feeling that this zone here is going to be a lot of support, and the falling wedge can pull right into these areas, and this could take weeks, okay? It could take into the new year. It could take till February. You know, we don't know, and as you can see, you know, 2021 is here. So we don't know how long this can take, but we need to be cognizant of the current pattern that's forming. All right, let's wrap this up with a conclusion. Why is this called the biggest short ever? Well, the biggest short simply because just look at our valuations, 182.9%. This is the Buffett indicator. Total market cap over GDP. Just how much higher can you go? That's absolutely insane. We have Donald Trump reaching, stock market reaches all-time high. That was today. Now what's so crazy is this is a chart of the M1 money supply. The shaded boxes is QE 1, 2, 3, and infinity right here. Yes, believe it or not, this is a log scale chart. You can see it goes from 4,000, this is in billions, so that's 4 trillion to 6.2 trillion in a year. That's a 55% jump. Of course, the market's going to reach all-time highs, but there's going to be dramatic effects to what's taking place. Do we know what those are? Well, we'll probably find out. What's the Fed fund rate doing? Well, last time the Fed started lifting interest rates up, well, that was in, into 2018 to 2019 before we had to really smash them lower. And during this period, we saw the market really grab hold and take, just a big downfall in around this time when rates were going up. So now they're saying that they're going to be holding rates down. Basically, they're not thinking about raising rates, right? So they said that, and they're not thinking about it until 2022 or 2023. All right, unless apparently, the Fed chairman said that they'll consider raising rates when inflation hits 2%, or basically when inflation starts to take hold, then that's when they'll consider raising rates. And they're saying that, a lot of people say, well, there's not going to be inflation, because the velocity money is not moving anywhere. Well, what happens if the velocity of money starts to move up? What's going to cause the velocity of money to move up? Well, what if the Federal Reserve comes out with their digital currency and then we start putting time limits to how the money has to get spent? It's a very big possibility. It's something that we need to be mindful of. Now, what does all this do? Well, here's just the reigning parade right now of Tesla. This is the big one on the weekly time frame. Yeah, that's a log scale chart too. Incredible valuations in an incredibly short amount of time. This by far is one of the biggest bubble stocks being valued at just extreme levels. I honestly, this just to me looks fraudulent, and I know that a lot of people are going to buy into this hype, and they're just everyday people are going to get completely just murdered on this trade. I just know it to be true. And why I'm pointing all this out, there's Jerome Powell right there blowing with a big bubble right now. You got to understand, bubbles, they can get very, very big, but the bigger that they get, the walls of the bubble become very, very, very thin. The thinner it gets, the smaller, something can take place in order to pop them. So be very aware of, hey, what can potentially happen in the markets to very well send us a lot lower. Okay, understand our reality. If you feel like the guy at Best Buy that you have to, take pictures in front of your computer with candlestick charts and show them to all your friends because you made a lot of money on Robinhood, chances are you're feeling like that guy did in 2006 or whenever it was, who came to me and wanted to show off all of his wealth. Look at bears make money, bulls make money, pigs, they get slaughtered. And understand this, if you are a bear and or a bull, both of the two can look very dumb at particular points in time. For example, bulls can look very dumb if they're buying at these very low levels because bears will say it's going lower. Bears can look dumb at these very high levels because bulls are making money, right? So the bulls think that the bears look really dumb. It's not until after we see something take place is when all of a sudden that then bear and or bull looks extremely smart. This is the biggest bubble. All right, everybody, that's all I got for you on today's market brief. Everybody have a wonderful weekend. See ya.